The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Well, hello, Buffalo. This is Ask the Tax Lady. She has the week off. We're nice to give her this week off, and I believe she's going to take next week off, too. So you're stuck with me and Tiff for 2 weeks. Hi, Tiff.
Hey, happy Saturday. I think the Italian festival is going on this weekend. Yep. What a great opportunity in Western New York. There's always something going on, and the weather certainly looks like it's holding out. And next week, tomorrow, you're doing a golf tournament for a great charity. And so that is amazing. You're doing for Make-A-Wish Foundation,
Correct.
the Shooting Stars golf tournament.
Yep.
And so what a great charity to do that. It's been going on for how many years?
The Shooting Stars has been going on for about 20. It's been 15 years of softball tournaments. And because of COVID, it got switched to golf.
Oh,
So
cool.
it's the gentleman in charge, he flowed with what was going on, and he's making it work.
Yeah,
so
great charity.
He's making at least 2 or 3 kids' wishes every year possible.
That's
just awesome.
Yep, great foundation. So yeah, Esther's having a great time, hopefully, and basking in the sun, and hopefully the rain holds off for all the activities. And so nice to be here with you today. And today we also have a guest in studio continuing our summer series. Before I introduce our guest, we're also doing seminars, Chris, starting off pretty soon for the big, beautiful bill.
Yep.
So that we can dissect it and explain it in easy layman terms. I'm going to ask you to tell the date in a minute, but we were just at your mom's house and your brother was there. And he says, I'm so excited about the big, beautiful bill. I don't have to pay any tax on my Social Security. And Chris went, wah, 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 wah. But when is the seminar? And it sort of ties in with our guest, what I just mentioned.
Starting the 6th, we're going to have 3 days. You can sign up for any day you want. It's the same seminar each day, the 16th, 17th, and 18th, right at our training facility on Delaware Avenue in Kenmore. We're going to go over everything. You have questions, we'll hopefully have the answers. We're uncovering new things every day. God, remember, it's a 900-page bill. Nobody's going to know everything for a while. We just found out yesterday that the 1099K, you hear us mentioning the 1099K. Anybody getting, now it's anybody over $600 who uses Venmo and all that, right? And we're not doing that to scare you. We're doing that to inform you. But that was just rescinded. It's going back to the $20,000 figure.
Wow.
So they're getting rid of that. Starting in 2026. 1099s for self-employed people. You don't have to issue the NECs unless you pay somebody more than $2,000.
Jeez.
So that used to be $600.
Wow.
So it's really interesting. And then for the gamblers out there, starting in 2026, you still have to claim all your gambling winnings, but there is good news and bad news too. The good news is if you go to the reservation casinos, which we're still not sure about New York, you won't get a yellow slip starting January 1st, 2026, unless you win $2,000 or more. So they raised that limit. So that's the good news. The bad news is the losses, you're only going to be allowed to claim 90% of your losses on your Schedule A when you itemize. So if you win $10,000, you're only allowed to claim $9,000 as losses.
Wow. So maybe I should just stick to the casinos that are going to issue them if it's $2,000 or less,
But it's crazy.
Wow. And so these are just things that we're just peeling back the layers of the onion day by day. And so the chips keep unraveling. You got to figure it went between the House and the Senate, and everybody kept on dissecting it and tearing it apart and adding and subtracting. And so when they did their sleepless nights and hashing it out, this is where it ended up. And then also you have to keep in mind that a lot of these laws are only good for 3 years. And so then they'll revert if nobody extends it, it'll revert back to old law.
And we don't know what New York State is doing yet.
Yeah, good point.
I mean, that's crazy. I had a gentleman in, he just moved from Iowa, and his CPA from Iowa said, I'm not touching your return anymore. You have New York. There's no way I'm touching a New York tax return.
That's so funny. Yeah, New York sort of sticks to whatever they decide, and they had a separation from the federal for the last many
8 years.
Yeah, 8 years, and so they completely separated from the federal law, and so they had a whole set of their own laws. And so I gotta believe that accountant was smart to tell him, I'm not going to do the New York return.
Yeah, if you don't know, don't do it. But we're live in studio, 803-0930, 803-0930. Get your calls in, star 930 on your cell phone. You can text in at the same number, 716-803-0930. And like Tiff said, we're continuing our summer series. And I think a lot of our listeners are going to be very interested in this gentleman that's here today. We got Mike Hayflick from the Financial Guys, and he's here to help talk about Social Security. He is a Social Security planner. He has a book out there that's getting popularity more and more, because just like taxes, Social Security is very confusing, right, Mike?
Absolutely. It's so good to be here with you both. I hadn't seen you in person in some time.
I know.
But I feel like, especially you, Chris, I've talked to you, it seems almost weekly. Either you've left me a voicemail or I've left you one, and we catch up to one another, helping each other for the sake of our clients. And yes, it's been great. The book's been great to not only write, get published, and have available to people, but it's been really interesting how to market a book. And obviously marketing the book just simply means we want more people to read so that they can reach out for that more specific help they might need. And the book's called Beyond Break Even. And we wrote that to sort of dispel the first notion I think people have when it comes to taking Social Security, and that's simply doing a break-even analysis. So, for instance, you could compare what you'll get when you claim at 62 versus what it might be at age 67. And then you have to do what I call a when do you think you'll die calculator, because you have to really guess your own longevity. And we just think there's so many other ways to address taking Social Security benefits.
And that's the thing. I know Esther right now, because she's going, don't wait.
I've heard Esther before say that.
And that's, it is. You have to look at all the options, and that's where I know us at EG Tax, and not just Mike, but a lot of other financial people, we get into big discussions about, should I take it or should I wait?
Yes.
Well, are you going to work? Are you not going to work? Are you,
Exactly.
Are you doing risky stuff with your life, or are you going to calm down?
It really is a unique decision based on a household's needs. And Russ Geiser and I, my co-author, friend, colleague, he and I wrote Beyond Break Even. And it's actually available, complimentary copies, to be honest, right on beyondbreakevenbook.com. We wrote this, though, because when someone turns 62, that's the invitation to take Social Security. And it's pretty persuasive, right? You can get X amount per month for the rest of your life. It's very, very enticing. But if you are working, Chris, you just brought up the idea of someone working, taking benefits. You can only make so much money.
Exactly.
Or you'll get forfeited months, maybe a whole full year of benefits. And so it's one of those things where you have to really understand all of the rules, all of the strategies available to you. And by no means, and to Esther and anyone else who thinks, take, I'd say we might tell you to take at 62 because it makes all the sense in the world, but it doesn't make all the sense in the world for everyone.
Right, and health insurance comes into play too, but that's more what we'll get into. Chris Fabian, Tiffany Fabian from EG Tax. We got Mike Hayflick from the Financial Guys, the Social Security expert. We're going to take a short break. We'll talk to you guys in 2 minutes. And we're back, family. That's right. You are our family out there, and that's why we do this every week. We bring in our special guests so we can inform everybody out there what's going on and how things impact their everyday life. So we'll read a fast text. It says, "Hi, forgive me if you've already gone over this, but is there or is there not no tax on Social Security per the big, beautiful bill? Thank you." And Mike's over here pulling his what hair he has left out. I know the feeling.
I know. I go shorter and shorter, Chris. Every haircut, I say any new grades popping in, they're getting cut off.
Well, I'll start by reiterating the story. We walked into Chris's mom's house, and his brother was sitting at the table. The first thing out of his mouth was, the big, beautiful bill. I'm happy about it, he said, because I don't have to pay tax on my Social Security. And Chris said, nope, not true.
Oh my goodness, it is maddening.
Yeah. So
I'm not upset about the bill for many reasons, but there is just really no truth to the statement of you will not pay taxes on your Social Security.
Right.
Because there are so many qualifiers to that. What did happen for some is the standard deduction went up, right?
Exactly.
Which can eliminate or erase a lot of someone's adjusted gross income or a couple's adjusted gross income. But I'm sorry, but Donald Trump, you've got to go into more of the detail, or at least say, go check out the IRS website for all of the specific rules that might meet your household. Because, it's just maddening, because then you get everybody thinking the same thing.
He's such a good salesman.
He really is.
He's a wordsmith.
He forgets, though, that there are some details that really do matter, especially when it comes to taxability. That's a real emotional topic, isn't it?
Yeah.
People with Trump and taxes? Yes, big.
Yes.
But we're not getting there.
To begin with, people under the age of 65 can collect Social Security, and the extra bump that they get under the big, beautiful bill doesn't take effect until you're 65. So all those folks under the age of 65 won't get that extra bump, so they'll feel no different than what it used to feel like. And then for folks over 65, they now get an extra $6,000. If their income isn't too high, they would each get an extra $6,000.
Sort of.
Go on.
And this is where it gets tricky, because before, seniors used to get a bumped up standard deduction. If they were single, it was like $1,850. Married was like $1,500 a person.
Correct.
Now, because of the big beautiful bill, if you're over 65 on Social Security, you lose that extra bump, but you get $6,000.
So something slides in its way.
So really, for a married couple, it's only an extra $4,500 per person over 65 they're getting. So they're going to get $9,000 deduction off their taxes, not the $12,000.
So it's certainly going to lower their taxability potentially if they don't make too much money. It's going to lower the taxability of their Social Security, but probably will not eliminate it. But there's a lot of people out there who will not have to pay taxes anymore,
And just what we went through for about a minute and a half of giving all these conditions, that is far, far more than simply saying no tax on Social Security, isn't it? I mean, you've got to read into the details. There's no change in how taxability of Social Security is now calculated. It's the same provisional income formula that's been used.
Yeah.
When you slide over from what the gross Social Security is over to the right, that is still being done the same way, and up to 85% of it can be taxed.
Yeah.
That's the adjusted gross income portion. But yes, it's about the standard deductions that you may or may not get. And so this just screams to me. Ask somebody who is in the know. Ask you both. Ask Esther or your fabulous team, scattered across Western New York. Find out how it affects you, because that's really going to determine, and this is one of my favorite things. I said to myself, I have to say this on the air with you both. One of my favorite comments that Esther has ever made is, It's not what you make, it's what you keep. So I love it. I say it all the time. I always give her credit. But I do. I think that that's how people ought to look at this. Not what's the rule. It's well, how does it affect me? What's in it for me?
Isn't that well said?
Right, but find out, right, from experts and specialists. So,
You work so hard, tirelessly. You work so hard. I mean, I work 2 or 3 jobs, and so it's not what you make, it's what you keep. I just love that saying that she uses, and so it's really important.
And we're going to go to the phones. We got Mark, who's been patiently waiting. Hey, Mark, how can we help you?
Hi, I'm closing out a family estate on a house, and I was wondering, what forms do you file for the federal and the state for taxes?
Well, if the house is listed under the estate, you would have to do a 1041, where an individual does a 1040 when you file taxes. The estate files a 1041. And then you would do a Schedule D, which is the same as on the personal side, and you record the sale of the house. But the nice thing is you get the stepped up value for the house. So hopefully you haven't had it that long and you're not going to pay any tax on that sale.
No, I've had it a few years, about 5 years.
And after the person passed away, did you inherit it or did it stay in an estate?
Stayed in an estate.
Did you guys rent it out at all?
No.
Okay.
So, yeah, I would ask your realtor that's selling the house what it was worth the date whoever passed away. And that's going to be your basis. And then if you did any improvements to it over those 5 years, that gets added to it to help defer the tax a little. Because we know here in Buffalo, the housing market went crazy. So it's possible you'll have a little gain you'll have to pay tax on.
Yeah, and don't forget about the real estate and the transfer taxes and the lawyer fees. You can also take that to adjust the basis. And like Chris said, it's going to go on a 1041. And the good news is probably it's only been a few years. So the gain when you get the stepped up basis is going to be negligible,
Yeah. What about the state? What do you file for the state?
The state has their own version of the 1041. And
it's hard because when we do the software,
I believe it's a 205, but I could be mistaken a little because if there's a 204, which I think are corporations, I think the 205 is the estate.
Okay, so there's a Form 205 and a Form 204.
Yes. Well,
right.
For New York, yeah, I'll look it up while we're doing other things or on a break, and I'll say it later on in the show. How's that?
Okay. I listen for the whole show, yeah.
Okay.
He'll look it up.
Thank you, Mark. Enjoy the weekend. Stay cool.
You do, and thank you for the information.
You're welcome.
Yeah, good topic. It's so funny for people listening out there. There's a lot of people that have things in estates, and a good rule of thumb is, Mark was his name who just called.
Yes.
And so his is the house and he gets a stepped up basis. But a lot of people have monies in IRAs and dividends and pensions and estates. And generally a good rule of thumb is the sooner you can close out those estates, the better it'll be for you, because the tax that you pay on a 1041 is much higher than on an individual. So closing it out and getting it and moving it into an individual's name can save you lots of money throughout the year here. And though what Mike just said, it's not
Mark.
what Mark. No, Mike Hayfleck. It's not what you. It's what you keep. So talking to people is a good idea.
Right. And speaking of estates, next week we're going to continue the summer series. We're going to have Jeff Katz on to talk about estate planning and everything like that. And just for Mark out there, it is the IT 205. I was right.
Good job.
All right.
Good job.
But now going back to Mike Hayfleck, I do got a question for you.
Oh, sure.
Because I remember growing up. I'm sure you remember growing up. Is Social Security going to be there when I'm ready to collect? How often do you get asked that? And what's your opinion?
So often. Russ and I probably do 30 workshops a year locally, as far as Nashville, Houston, down in the West Palm Beach area. And almost every workshop, Chris, someone does say that near the end when we do questions and answers. And we always say, listen, they've always done something. Who do we mean by they? The politicians. Mm-hmm. But I always say, unfortunately, the politicians are not always problem solvers. And they are afraid to be problem solvers, especially when you talk about Social Security and Medicare. But the facts of the matter are there are so many things they could do. There, as you both know, there's a limit on how much the FICA tax is paid on. And this year's limit is $176,100. So that means if you make more than $176,100, you don't pay the FICA tax of 6.2 on that. They could just simply either remove the limit or raise it,
Well,
and create lots and
they
lots more.
did just add, if you're over 400,000, it kicks back in again.
Oh, no kidding. Well, there they go. So
So-
we should be hearing something about the sustainability of that Social Security Trust Fund now.
It's crazy what they're doing, and
Well, it's not all out there yet, as you just informed me.
Is it 400,000 married, single?
single.
Okay, so married couple would be
Who knows?
okay.
We'll find out.
Yeah.
You
We'll
want-
find out.
And and then don't forget too, when you're over 200,000 single, 250 married, you pay extra Medicare tax on your tax
Oh,
return.
yes. IRMA. We
Yeah,
talk
and then
about
there's IRMA as well. that-
IRMAA. And
Yeah.
we could go into a whole show about that.
You want to read the text now or after
Sure,
the break?
we'll do it real fast. Just to clarify, there is only one New York State standard deduction. There's no senior citizen standard deduction like there is on the federal return, correct? And yes, that is true. New York doesn't add to their standard deduction, but they do.
They're kind to
They're
retirees.
kind. New York, for the states that have taxes, they're one of the best states out there to retire in.
Absolutely.
Because the Social Security is all tax-free on New York State. So there, that is correct on that statement.
Yes, that is true.
But then a regular person on retirement, on 401ks or IRAs, the first $20,000 is tax-free per person. So if it's a husband and wife, then they're both, that's an extra $40,000. Add their Social Security, their standard deduction to it. So they could be at around $90,000 tax-free in New York.
Absolutely. Absolutely. So you could all gripe out there if you'd like about different things about New York State we don't like, but when it comes to retirement and income in retirement, it's pretty friendly.
Yep.
That's right.
And so, Chris Fabian, Tiffany Fabian from EG Tax. We got Mike Hayflick from the Financial Guys talking Social Security tax questions. You have the questions. Well, hopefully, we have the answers. We got to take a break for the news. We'll be back on the other side. Family. And we're back. Chris Fabian, Tiffany Fabian from EG Tax, live in the studio on WBEN. Give us a call at 803-0930, 803-0930. We'd love to help you with taxes, and we even have Mike Hayflick here today from the Financial Guys to help you. You know, do I take Social Security? Do I not take Social Security? And, you know, before we take Kevin from Pendleton, I know we talked before the show, and you brought up widows. And there's a lot of things widows don't know.
Widows have so many more choices.
Or widow, yeah, whatever. Go on. I'm sorry.
No, that's okay. They widows often, I mean, obviously, it's a tragic thing to be left alone after a marriage, or in some cases, people were divorced and then the person they divorced dies, and there are benefits that might be coming your way. Even if you had divorced years and years ago and that person has passed, or of course, if you're married and you are left now on your own, there are what we might call switching strategies. You know, when you're a single person, individual person, it's a little more straightforward. You claim whatever benefit you're allowed at whatever age between 62 and 70, and off you go, right? But when you're widowed, you might have choices. You could start on your own benefit as early as age 62 and maybe switch to that benefit that your deceased spouse had left you, maybe as late as age 67, probably not later than that. Or you could start on your spouse's benefit as early as 60 or even 50 if you are disabled, and then later switch to your own benefit as late as age 70, because your benefit is basically available between 62 and 70 in most cases. So all of that said, sometimes people don't know that they even have a benefit. You had an example. I have a great example. A woman that lives in Pennsylvania. She's someone I met through a client. It's actually the client's sister. And her name is Carol. And I said, Carol, explain, tell me more about you. And she said, well, I've been divorced. My ex has passed. I'm still working. I'm about 60. I think she was 63. She says, but I know, Mike, already, I can't take Social Security because I make too much. And I said, wait. We've got to break this down. It turns out she did make too much money to get a full year of Social Security benefits based on her ex, who's now passed, his record. But she was eligible for 7 months of a given year for the following 3 years. That was like another $12,000 to $14,000 more dollars a year for 3 more years. And then her plan was to then take her own benefit. We literally found her tens of thousands of dollars.
That's awesome.
And the worst part is that she was told by Social Security that you make too much. And that was the end of story to her. And it wasn't true. She didn't make too much to get something. She made too much to get 12 months worth of benefits, but not enough to get something. And it literally was game changing to her.
Isn't that terrible? The expert that she called, Social Security, who issues the money, didn't have the right answer.
And to that point, like it's literally written in the Program Operations Manual System, POMS, for all the agents at Social Security. And many, I'm sure, are wonderful people. But it's written, do not attempt to persuade claimants into anything. Just follow directions. Yeah. So sometimes you get a very smart person, I'm sure, and it might be very helpful information. Other times you get something that's very, very unhelpful or wrong. You can't base it on that. You should come to someone like me. I've got a lot of colleagues now who are certified in Social Security claiming strategies, and we know the rules. We know what might apply to you. And then you go in armed with information to Social Security and you say, I know what I'm allowed. I want you to help me get it.
Well, now I know why when clients call or come in for a consultation, they go, why didn't Social Security tell me that?
Exactly. They're not supposed to. So honestly, if they say, listen, I can't help you with the strategies here, they're actually doing the right thing for people. But then people don't know where to turn.
Yeah. Wow. Crazy.
Yeah, lots of
Crazy.
money out there in many cases. So widows have choices. It's hard enough to be left alone, financially speaking, especially. So it really is important to know the rules.
Even for a divorcee, it's 10 years, right?
Yep, married for 10 years, and you could still be eligible for additional benefits, not a full benefit while that ex is still alive, but you might still be eligible for more based on your benefits compared to that ex. Yeah, lots of things. And we always joke, Russ and I, when we do workshops, we'll say, listen, I know you've been through a divorce. You don't want to see that person. You don't need to. You don't have to set up like an Applebee's encounter and say, well, what are your benefits and what are mine and what do we each get?
And it doesn't affect his benefits or her benefits at all.
No,
so,
you've got to get that information, though, from Social Security. That's not something we can do for people.
Crazy. Okay, and we got Mr. Kevin from the islands.
Yeah, how you doing, Easy Tax, folks?
Good.
We're doing
nice
good,
to
Kevin.
Talk to you.
Yeah, and then you got in your presence there, Mike Cubed.
Yeah.
Mike Cube. A lot of mics in our office. I know, Kevin. Good to hear from you.
Yeah. 3 of them on this show. It's not Mike Squared, Mike Cube. Anyway, 3 quick questions. I'll keep it piffy. I know it's they say that if you take Social Security, whether you take it early or you take it at 67, if you still decide to work, they give you some ridiculous figure of $20,000. First question there on that is that does that also mean that if you own your own business as an independent contractor or just your own business, are you limited that way too? The next question is, I've looked up some Social Security experts who say that taking it early is not bad because while you may lose some money if you don't wait until 67 years young, you're only off by a couple $100 based upon your status. And third and last, if you work out of your primary state, let's say use for example the crumbling Empire State of New York, and you work like in New York you work like in Texas, Ohio, Pennsylvania, wherever, right? And this might be more a tax question for you, EG tax folks. Is it based upon when you do federal, based upon your primary residence, or do you still have to end up paying some taxes based upon the specific states of where you work? That's my 3 questions, and I can listen all the year. Thanks again, guys. Appreciate it.
I will do the last question if that's okay.
Sure.
So thank you, Kev. So if you work in different states and you collect Social Security, it is your home state where you're a full year resident. And so now that if you were a part year resident, if if your homestead was part year in New York and part year in North Carolina or South Carolina or Virginia, then you would have to split up the taxability. But if you were a person who worked in other states and your homestead was in New York, so for instance, if I was a contractor or let's say I played for the Buffalo Bills, let's do that one, and New York State is my home state, but I play in North Carolina, I play in Washington, I play in Georgia. They get W-2s for all those states that they play in, but they have to report their Social Security just on their New York because they are a full-time New York and they're a non-resident of those other states.
You would have to file a tax return based on the income you earned from those other states. And then
the Social Security is only taxable.
Right.
The issue.
Right. But the tax on the income is to those states. And then when you file your New York as your resident state, you would get a credit based on the taxes you paid to the other states. So
is it confusing, Kev, or is it confusing?
No. It wasn't confusing at all. I mean, no, I raised it down and, although I might have been from the islands, I have a little brain there. Coconuts wasn't falling on my head.
Very confusing.
Yeah.
And what's the first question about when you take your Social Security, whether you take it early or whether you take it at 67 years young, they say this ridiculous amount of $20,000 maximum you can still work. Does that impact you if you own your own small business or as an independent contractor? Are you still limited by those numbers? $20,000 a year?
Yeah. Kevin, there's a little bit more detail in there than what I can maybe explain.
Okay.
So there is an earnings limit. The earnings limit, if you are taking Social Security, goes away at whatever your full retirement age benefit is. If you were born after 1960, that age is 67. So you can make whatever you want at age 67 and beyond. People's full retirement age, though, is based on the year of birth. So if you were born 1954, it's age 66. 1955 is 66 and 2 months, and all the way then up to 1960, it's age 67. But the earnings limit is a W-2 gross limit, so you cannot reduce that gross by some IRA contributions, for instance, and think that you're getting away with it. It's gross income.
But for self-employment,
net of expenses. So if you make $40,000 and you can write off $18,000 of it, you'll go below this year's limit of $23,400. So again, there are some specific, I guess, little caveats you need to know. And it's all by one person's Social Security income. So someone at age 62 whose spouse makes a whole bunch of money, that doesn't matter. It's only on your own Social Security income. So I don't know, you guys might know this far better than me. If you have your own business and you both as a married couple can work, can't you identify certain income to one person versus another?
You could say the business, if it's,
Yeah.
You could, if it's your business, you could give her a W-2.
Yeah.
And
based on your pay and responsibilities, you could maybe
and then
make that
also
work.
You may want to incorporate, because if they're just looking at W-2s, you pay yourself $20,000 and you have a net profit of $30,000 coming over as passive income. Social Security doesn't look at that,
right?
Which is crazy.
Yep.
But there's the gray area.
There's a gray area, and there are ways you can take benefits earlier than your full retirement age and make it work. One example, Kevin, by the way, like when this can work, I think of nurses. I think of medical professionals. They work so many hours, and they're on their feet for 12 to 16 hours at a time. They finally retire. They might have a pension. They might want to take Social Security at 62, 3, 4, whatever. And I say that's okay. There's an earnings limit, though. So they can work per diem, work 1 or 2 days per month, maybe, and stay under that earnings limit. So you just need to know it, or you're going to be surprised when you aren't getting the check that you expected.
Right.
But
and the last question, of course, if you take your Social Security, as I say, some former Social Security experts and so on tell you, hey, take it early. Some of them say, Social Security might dissolve or whatever. But let's say you take it and they're saying that it kind of all works out in the end. And even if you lose money when you turn 67, it's just about a couple $100. What is your take on that?
My take is this. The benefit at age 67 for someone born 1960 or later, think of that as the 100% benefit. If you take as early as 62, that benefit is reduced 30%. So if you are in that sort of group who thinks, oh my gosh, Social Security might dry up, I might not get what I expect or deserve, imagine your much reduced benefit from age 62 getting reduced by 24 or 25% versus the bigger benefit that you could have waited
If you're retired.
for. So you actually end up worse if you take sooner and then it's reduced, right? So to us, we have to work based on your household. This is a very unique decision. Some people should take at 62 and can without penalties or any forfeiture. Other families, especially married couples, you need to be thinking of your surviving spouse. And when two people take early, the bigger benefit stays, the lower benefit goes if there's a death. And sometimes, unfortunately, the women are the ones who outlive the men. They are often left with very, very small benefits that their early claimant husband, in this example, early claimant husband took the benefit early because they thought, well, I better get it while it's there. And then they pass away. They pass on a very small benefit to that surviving spouse. That can be very big and very detrimental.
Okay, great. Hey, thanks, guys. And by the way, with that last part you just mentioned there, I still won't marry a guy based on that, okay? I know the women live longer, but that's okay.
We actually write in our book, though, that
Thanks,
this is...
Kevin.
Thanks, Kevin. This is a stat. 80% of women die married, and 80% of men die married, and 80% of women die single.
Wow.
And that's a given fact. So unfortunately,
Well, are you saying that women kill the men?
I don't know. We could go deeper. I don't know. If we should.
But we're gonna-
Hey, from a medical standpoint, it says that women and men live longer if they're in a married relationship. Yeah.
Very good.
But we're going to take a short break for the final segment of the show. Chris Fabian, Tiffany Fabian from EG Tax, and Mike Hayflick from the Financial Guys. We'll see you in a couple minutes. And we're back. And pretty soon that bump in music at the third segment's gonna be hey.
Yes.
It's spring.
Yeah.
It's summer. Why is it called spring training?
I don't know.
Training. It's summer training. Bills will be back pretty soon, which is gonna build Buffalo up great, bigger and bigger, which is awesome. But again, Chris and Tiffany Fabian from EG Tax, Mike from the Financial Guys. Mike, if somebody has Social Security questions during the week, what's the best way to get in touch with you?
Probably 833-FIN guys if it's a out of state. For instance, if you're here in town, Western New York or even Rochester, 716-633-1515.
Yep. And they got a great team there. You know, it's unbelievable. They get you covered with whatever you need. They basically have somebody there that can help you.
We do. I think Mike and Glenn in their vision had always been like a kind of a one-stop financial shop. And I have to say this on the air. I think I mentioned to you, Chris, as you let me in here today. My younger daughter, Madison, actually did her sort of debut on radio today. And talked a little bit about the home and auto area that she's in, and a great case where she saved a family $1,000 a year, got them better coverage on home and auto insurances. So that was fun.
That's your daughter?
Yeah, my
Proud
younger daughter.
dad.
Michaela is not in the financial field. She is a PA helping people with endocrinology issues.
Okay.
And so Maddie, though, has been with us now over 2 years.
Because
So
our daughter Gracie works for us now.
Oh, nice.
And
We got to get her on the air.
I know.
Absolutely.
Kudos to her for. I think that gives me the biggest rise when you save people money. It just goes to a place in your heart and soul that you can't even explain, and so and those stories will stay with her forever. And so kudos to Maddie.
Thank you.
Maddie,
Yep.
yeah.
And those people
Absolutely.
will remember that too forever.
And
Oh, yeah.
How she
No
did
doubt.
that.
That's
so.
the biggest marketing. I can't. I hear all the time. You you got to go see Chris, you got to go see Tiffany,
Mm-hmm.
and you got to see Mike, you got to see people at our office, and so it's just a huge compliment, and that's because Esther always says you have to have a heart to serve, and Esther always says it's not what you make, it's what you keep.
I love that.
Yeah.
Absolutely.
Yeah.
Okay.
We all need specialists, right? I mean, if I
Exactly.
think of everything else in my life, you name it, anything relating to my car, my home, anything else, I feel like I have to call somebody. Taxes, right? I
Yeah.
don't know enough. So when there is an area that you just can't really maybe go so deep into yourself, just find a specialist, right?
No,
Make-
and that's
make the
I have
outcome the
clients
best it
all
can
the
be.
time come in, and when we're done with I'm sorry, I should have known this. No. This is my specialty.
Exactly.
Your specialty is car mechanics. I can't fix my car. You don't want me to fix a car.
Just like your other daughter, she's an
Yes.
endocrinologist,
Yes.
and that's her specialty in thyroid and
Exactly.
diabetes, and
Yep.
and so you got to go to her for those
Absolutely.
things. Yeah.
No doubt about it.
Okay, let's go to Tom from West Seneca. Hey, Tom.
Hi, I was just wondering, do you think there'll be a cost of living increase in Social Security this January?
I do. Since 1975, it's been a legislation that if there's a rise in the CPI, that's the Consumer Price Index, and they use a certain index, but if there is a rise in that, then they will also do a corresponding cost of living adjustment for people. The average, just so if you're listening out there, the average over the last 20 years is probably in the 2.5% to 3% range of raises. This year's raise, what they do is they look at the July, August, and September increases of pricing. They compare it to the previous average of July, August, September of last year. And then just around the first, second week of October, it's declared what that cost of living adjustment will be. My guess, because there hasn't been significant inflation this year, is it's probably going to be sub 2%. I mean, maybe 1.5% to 2% of a raise.
And
But-
hopefully that's enough to cover the Medicare increase.
well, there is often that, but I would still say this. I think that it's often understated how significant compounded cost of living adjustments can be in someone's life. So year after year after year, getting adjustments like that can lead to far, far bigger incomes in your future. You know, we know a lot of people, I'm sure you guys do the tax prep, people who have private pensions. They've been getting $17, $12 a month for 13, 14 years, 25 years. You do get raises on cost of living in Social Security if there is one warranted. So I like to not diminish that fact, because I think the media often does a poor job of saying, well, they should use a different CPI, or, oh, it's too small. Or to your point, Chris, some of it's taken away by the higher Medicare Part B premium. However, it's still a raise. We should at least appreciate that you will get something more.
Wow. So that was a very good way of yes, we think there'll be a COLA, but not so big.
No, because there just hasn't been as many feared a really big rise in prices. And I mean, based on the CPI that's used, I think it's called for urban wage earners and clerical workers. That's the official title of that CPI used. I think it's still significant to know that you get raises, that this income is guaranteed. As we've talked about, it can be very tax favorable too. So I think it's something to really strongly consider what your claiming decision's going to be.
So
Okay, thank you very much.
Thanks.
You got it,
Thanks, Tom.
Good question.
Okay, we'll do a fast text before we go to Eileen. My father recently passed away in May. My sister and I are the only family left. What death benefit do we get from Social Security? What is the new death benefit?
Oh my, I think it's still been, isn't it something like $255 or
It's
It
something?
not
used to
much.
be. I saw this year doing taxes where it was 1 month of their Social Security.
I don't know
It was
about
really
that.
weird. It's varying.
I feel like you're always paid Social Security benefits 1 month in arrears. So if you passed away in May and you were already paid, let's say for April, that's okay. But if you get another payment in June I
then you gotta
believe
pay it
I
back.
think it gets
Yeah.
pulled back out
But
of your
yeah.
bank account.
So it could be $255. It could be. I
which
mean,
is
this
just
would be
so pitiful. Really,
Yeah.
they ought to raise that. So upon death, I believe it's still something very small.
Yeah,
Good. Yeah.
that's a question Social Security can answer.
But
Unfortunately.
it's unfortunately not much.
Yep.
It's not
Yep.
a lot.
Okay, and we'll go to Eileen. Hi, Eileen. How can we help you?
I'm over 65 and blind, and I would like to know what my standard deduction will be.
Well, it will be roughly, and this is going to be rough figures. It will be the $15,000 plus you're on Social Security, right?
Right.
So you'll get the extra $6,000, and your income's under $75,000. Let's make
Yes.
sure. Okay, and then you'll get for being blind the extra $1,850. So you're looking 23,000,
23,000.
almost $23,000.
Oh, okay, because I thought maybe they might have dropped the blind, but they left it
Yeah, as
Thank
far as we
goodness.
know.
1850.
Yep.
Okay, thank you very much.
You're welcome.
Bye-bye.
Bye-bye. Yes, I mean, so there's a lot of things out there. I mean, we're just tipping the iceberg, right?
Do you
With
wanna
Social Security.
Read one of the texts.
What is the name and contact for the guest on EG Tax today?
Well, that's easy. There's a few texts, but well, that one's Mike Hayfleck, Hoeflich, and he works for the Financial Guys. And the phone number at the office is 716-633-1515.
That's correct.
Okay, and there's another number if you're out of the area, but the 633-1515 is good. But wasn't there another question about Social Security or a tax question? Yeah, my
there's
father recently passed.
That's the one I just read.
Oh, sorry.
Which year did you say the 1099K will go back? That starts 2025.
That's good
Believe
news.
That's so this year 1099Ks will almost be a thing of the past again.
Wow.
So
It is $255,
But
by
it
the way,
doesn't
the
mean-
death
oh, is it?
benefit.
Okay.
Only
It-
$255.
and
Wow.
it means you still have to report your income. If you don't get a 1099K, you still got to report it. You got to be honest.
Right.
I got to say that as a
Yeah,
tax-
like what we said earlier, it's not what you make, it's what you keep, but keep legally, right?
Yeah.
Yeah.
Not by avoiding or evading.
You
We
don't
would
want to
never,
get
ever-
caught
No,
in,
no,
in that wormhole with the IRS
No.
because wow, they can people don't know this too. You get audited and they're like, "Oh, you live in Clarence and your income's only 50,000? How? We think your income is 300,000 in your business and that's what you got to pay tax on." And it's up to you to prove otherwise. And if you can't, you got to pay tax on that 300,000.
Boy, oh boy.
And I think there was a text in here, Chris, correct me if I'm wrong, and I hope we didn't answer it. It says, do you believe, Mike, it's always a good idea to wait to the age of 70 to start collecting Social Security?
Absolutely not. No, here's a case, though. A surgeon, 68 years old, with a much younger spouse, 59, who didn't work as much. That surgeon does not need the money at age 68. Why not wait until 70? If you pass away then, surgeon who's 70, you give that bigger benefit to your surviving spouse. How about that? That makes sense. Not every case makes sense. So we're
Right.
not advocates
And
of any
that's-
particular age.
Yeah. What's good for one isn't good for the other.
Exactly.
Just like taxes, Social Security, everybody's individual. If you need help with your Social Security, please call Mike, 633-1515. He'll love to help you. If you have tax questions, tax planning, call us during the week, 632-7886. We'd love to help you. Our school's starting soon, and don't forget our seminars on the Big Beautiful Bill. Until next week, we'll see you then. Bye-bye.